Well, here we are, and welcome to one and all. This is the second live stream from Bath, and I think it's working. I tell you what, I will be waiting with bated breath for my full studio to arrive, because at the moment it's a little bit tricky. We don't have lots of the facilities we normally have, and I have to do lots of manual stuff. But anyway, we're here, so great to see everybody. And Tony Locantro is ready to come in just a moment. Can have a very interesting chat with him, of course. And just before I start, I will, as always, remind you that we moderate the stream here, so we feel free to use the chat, but just be careful. Also, of course, we don't provide specific financial advice. This is just a general conversation, and Tony will re-emphasize that shortly. But you can ask questions, and if you use @WalkTheWorld, when you ask a question, I'll make sure that I see it. We've also enabled Super Chat, which means that you can get your question talk through, or indeed make a contribution to what we do around here, which is always greatly appreciated. Anyway, without further introductions, let's push this button. Hello, Tony.
Hey, Martin. G'day to the audience. It's great to be back.
It is good to see you again, and everything's working well. So it's an interesting Perth to the UK, to YouTube, and back to people watching all over the place, including Australia. So it's interesting that the technology works well, but it's great to have you back. So much to talk about.
Oh, there's absolutely heaps to talk about. I just caught a tweet on the budget and $500 electricity bill relief and some other stuff happening, but I think that's leaked enough. But at the moment, yeah, very, very interesting times. And I think now certainly is the time not to get complacent. And I'm going to run through a bit of a slideshow. I'm also going to provide a few ideas of what I'm doing as well. So, yeah, who'd have thought a year ago we'd be at 0.1, and now here we are at 3.85. So, yeah, wow.
Yeah, and the 3.85 is not necessarily the peak. You know, the RBA was saying they might need to put rates up higher. We saw, of course, the US, ECB lift rates. The Bank of England meets on Thursday. The expectation is they're going to put rates higher as well. So the inflation is sticky, embedded, all of those things. And so central banks have been turning up the wick. It's the fastest increase in rates ever, and it's worth just reflecting on that, right? And of course, in Australia, we've got huge amounts of debt. People are highly leveraged, and a lot of people are struggling with the changed environment. And to the extent that the budget provides some relief to some people, it'll have a marginal impact. But to my mind, they can't address the significant impost on household budgets that have been created by inflation, high interest rates, and everything else. So it's pretty tricky.
Yeah, that $500 energy relief will go through you like a dodgy Vindaloo. I mean, Mark McGowan's been really generous in WA, and you think, wow, I'm on free electricity, crank up the aircon, suddenly that bonus has gone. But the way I see it, it's putting a Disney Band-Aid on a gunshot wound, but too little too late. But we'll let Chalmers take all the plaudits for it. And interesting you mentioned interest rates. One of the opening lines, I actually went to a lunch with Chris Joy. He had a presentation lunch on last week, and he said he was talking to a young fundie, and the young fundie said to him, this is a while back, he said, I don't think I'm going to see interest rates rise in my lifetime. So, yeah, that's similar to no Australian child will be living in poverty by 1990, and there'll be no interest rate increases by 2024, and Kingston Town can't win. So there you go. You look at some of these things that was indoctrinated, that someone was going to say, look, interest rates are never going to go up in my lifetime. Isn't it ludicrous? But now look where we are now, Martin and viewers. It's It's not good at all. And you could always feel some sadness as to where this country's going, and in fact, the world. And you only have to look over the ditch to see what's coming. So, anyway, well, do you want me to start the slideshow?
Yeah, just before we do, it's worth just saying, 3.85% is still a low cash rate relative to long-term history, right? So we are not at a rate of interest that you would expect to correct back down. In other words, this is the new normal, around three and a bit. A lot of people haven't woken up to that yet, Tony.
No, it's all happened too quickly. It's like you're playing an AFL grand final and suddenly you're 50 points down by half time. Then you wake up and think, shit, we're in a game. And I think that's really finally started to hit the consumer, who are going to slam shut their FPOS card, let me tell you. And I'll certainly run through that in more detail.
Great. And just to answer a question from Rolf, is Leith Van Onselen coming on? He's on next week, so watch the live show there. Anyway, Tony, I'll leave you to run through your presentation, so share your screen and off you go.
Alrighty. Okay. So there's the usual disclaimer. Basically, that covers me. I'm just going to tell the truth. I'm going to make some forward-looking statements, and it's not personal advice at all. It's general advice. So turn to someone else if you need that advice. So I think that's where we're at. Where at the moment things are calm, and we're heading into that situation. There's the twister, the storm. I just think this is probably a calm period. And as I mentioned, just don't get complacent. Now, I went to lunch with, I had a lunch with Chris Joy. There were about 30 other people there. And Chris, the slide that stood out, this is before the height, around the height, is that pauses in the height cycles when they're hiking are common. So Chris said that you can have a long pause. It doesn't mean the cycle is over. And if you look there in late 2010, there was a 5-month pause. So to me, that was the slide that stood out. And along with the young fundy saying rates will never increase in his lifetime. And I like the line of a pig passing through a python. And I think that the pig passing through the python is going to be the demand for the Coldplay tickets, which I'm going to get online and try and buy. So the way I see that is 600,000 people bidding for 60,000 tickets. It would have been like trying to buy a 2-bedroom unit in Leichhardt for $2 million without a car bay. So similar pressure there on everyone to do that. So anyway, I copped some shit over my tie. I will promise not to wear that tie at these events in future. As you can see, Chris is very photogenic. He's had an interesting track record, and there was 2 magic words that stood out, and they're not Anacott steel. It was mispriced debt. And Chris reiterated to the audience that he bids for hundreds of millions of dollars bonds. His funds perform well, and what he reiterated was that he's sticking to 15 to 20% downside on national property. So we have, in his calculations, another 6 to 10% to go. So I actually expected Chris to be a lot more bearish, but I think he's looking at the immigration situation and potentially rates stalling for some time. But he still thinks they're going higher. He thinks US markets overvalued. Well, no shit, Sherlock. So that's all certainly looking good. And I might add that I am going to get a photo with Stephen Koukoulas. He's keynote speaker at a mining conference of all things on the Gold Coast. I'll be there. Apparently, he's going to buy me a beer, which I'm going to refuse. I'm actually taking a year off alcohol, so I'm 5 months into it, and it's looking good. So hopefully next time, guys, I'll have a photo with the Kook. So CBA's come out and said houses gained 5% this year, Melbourne are up by 2%. I think you've got to be really cautious about this because the banks have certainly changed their tune. We're looking at the population growth, immigration. I think, honestly, that's just going to destroy the rental market even more. And one of the sites I follow on Twitter, Clown World, actually had a queue of Australians waiting for a rental, looking to inspect a rental property. So I just think the entire rental market is out of kilter. Kind of takes me back to 2005, 2006, where I had to overbid to get a rental. But I think at the moment, it's certainly ridiculous. I can't see those immigrants rushing straight to buy Narrabeen Frenchs Forest property at all. But I think, it's going to be certainly a more competitive landscape for the rentals. So again, couples, Scott Pape suggests to have a finance date with your partner. I just think that as a nation, we have this she'll be right, mate attitude. And I think that couples now should get together and go through the finances because it's like a lot of zombie companies. Families' balance sheets are going to look, a lot of families are technically trading insolvent. So again, you've got to look at your situation, and that needs to be reiterated. I don't think there's enough financial counsellors to cope with what's coming. So, rates up to 3.85, only up for 0.1, fastest hiking cycle in history. Interestingly, 40% of NAB customers are trapped. So this goes back to liar loans, it goes back to higher rates, it goes to testing. It's the vibe, it's Marbo. What a shit situation for families to be in that are mortgage prisoners. And I can't reiterate enough the mortgage cliff that's coming, and there'll be a slide on that shortly. And Wellington, look over to New Zealand. They're actually leading us at the moment. Defaults are through the roof. New Zealand had, New Zealand, Canada, Australia, the trifecta of housing bubbles. And again, I know it's prices of ease. They've probably increased in some areas, but not over yet. Interestingly, there's a photo of me on the left. That's my first birthday. We were living in a unit in Manly Vale, such a rough area of Sydney. I then made it to 13. I was a mad Parramatta Eels supporter, and we were living in Terry Hills, which is now blue chip. And that takes me back to when units and houses were actually affordable. And on the far right, you can see a unit in Manly Vale, and that's a similar unit to what we lived in. My father was earning $4,000, roughly $4,000 a year, and I think he paid $12,000 for that unit, or pretty much 3 times his income. You can see there that Belrose was kind of expensive compared to Avalon Beach. You could buy a block in Belrose though for 12 grand. Lots of fibro houses in North Narrabeen. But this takes us back to the 70s, a time where 3, 4, 5 times your income was the norm. You could have pretty much live on one income. There was much less stress. And then everyone can say, look, times are different now. But in reality, if you look at the demographic index of housing affordability, price to income, they say anything over 5 is severely unaffordable. And you go back and have a look at Sydney, which is 13.3 times. And that's an indication of how much pain families are going through to provide housing. So anyway, I'll look back at that page with great fondness, and takes me back to my youth. So in 2021, you were able to get a mortgage for 1.99% interest, 16 grand interest per annum. Now you're looking at $52,000 to $55,000 in interest. I actually got sent a Aussie home loan rates page from Cookie, bless you Cookie, and on those figures, you'd be looking at $64,000 to $70,000 in interest. Now, how the hell any one family can afford that when they're budgeted for that low interest rate and the asset they're in is likely to lose 30% in value? So again, more stress. There is no worse stress that leads to anything else than financial stress. And I think that's going to increase. We're going to see more counselling. We're going to see greater levels of depression. We're going to see people wheel a trolley in straight to the Woolies meat section and wheel it out. I just think we're in for tough times. I think a lot of these new housing estates are going to turn into ghettos. You just watch people start to, their lawns won't be as kept as nicely. We'll have youth crime. And I just think that there's going to be a spate of robberies, insurance fraud, everything that goes with a society that's decaying like a junkie's teeth. And to me, that all spells being sandpapered to death by Dave Hughes. I just don't think, to be honest, the economic and social situation in this country could get any worse, fueled by the mother of all asset bubbles, which was the result of COVID. I think that in the end, cheap money, it was great. You could get yourself a black T-shirt, put a fancy logo on it. VCs will throw $500 million at you. I think what cheap money does, guys, it creates delusions of grandeur. It creates unnecessary spending. And the sad part is people are going to lose their jobs, their livelihoods. They're going to struggle to pay the mortgage. Combine that with a mortgage cliff, and I just don't see any way out of it. So out we go. Meals, bye-bye. Retail spending, dining and takeaway in the bin. Macca's, too expensive. KFC's actually reasonable value compared to that. Alcohol, I'm alcohol-free this year. Life is certainly much cheaper. I don't go out as much. I don't go to the pub as much. I cop a lot from the guys at work, but so far so good. I'm smashing the gym, healthy lifestyle. It's a good addiction to have. Beats gambling and drinking. Holidays, forget it. Who can pay $2,500 to take the family to Europe? Cruise ships, just a breeding ground for diseases. Then we've got the fun parks. And now the streaming services, bye-bye. People will just focus on joining one, watching what they want, cancelling and moving to the next one. Now, the sad part is that fitness goes, so gym memberships, questionable. And then, unfortunately, medication. So that's another area, even though there's going to be some relief and now you can get 2 months worth of pills. I think that people are foregoing their health as well. So that's what I think inflation's like. And, you know, if you ever tried to remove that with a stick, you know you're due for failure. So you call it sticky. Some say it's transient. No, to me that's inflation. And interestingly, I recently back from Hungary to visit my mother-in-law, and my son got out his phone and started calculating the prices of food in Hungary, and he converted it to Aussie dollars. And a basket of groceries in Hungary cost $61 Australian equivalent, and that was exactly pretty much the same as that basket of goods in Coles. Unbelievable. They're struggling there with 25% inflation. The only real cheap thing in Budapest is cigarettes. So 32% of the population smoke. The place absolutely stinks. And alcohol is cheap. And you only have to walk around on a Sunday morning. Lots of Brits, lots of hens parties, bucks parties. So they all go and do their best to destroy Budapest. But I just found that heartbreaking that to live simply, they've got to pay as much as us. And we earn, on average, 4 times. The only real bargain my son spotted was 32-cent bread rolls in Lidl. And I just thought it was interesting that my mother-in-law's pension is the equivalent of $270 Australian per month. So again, we've had this cheap money. We can go and blow it on restaurants, nights out, new cars and all that. But people in other countries are certainly doing it tough. So rather than focus on the negatives, I'm just going to quickly run through what I'm doing on the market. I should reiterate that the last 18 months have been the toughest of my career. And that involves business. It involves having real companies valued fairly by the market. So the way I look at it, this is like buying a unit in Manly Vale or a house in Narrabeen or Avalon, or, you can even go to North Curl. And I've told this story probably too many times that when I was a police officer in Bondi, I was actually able to buy a unit in Bondi for 2.4 times my diabolical police salary. And this was coming out of the recession. And I know others would say, oh, look, times have changed, Bondi's changed. Yes, there's now a Chemist Warehouse in Bondi just to cheapen the suburb up further. So I'm still focused on precious metals, gold and silver. Gold's had a bit of a run over, I think it got to about 2080, currently 2026. I think copper will have its day. Biotechs have been absolutely poleaxed. I sat there listening to Chris Joy's performances, and I was thinking, well, if I look at my biotech index, I mean, it's virtually halved. And anyway, so I found that rather humorous. I'm certainly not going to flex about that. So these are the stocks we're buying. What I'm suggesting is get financial advice. People say Locantro pushes penny stocks. Well, that's your own prerogative. I like to find companies before other people do. They've all got outstanding fundamentals. The prices have been smashed for no reason. And I think it just goes to show what can happen when liquidity is sucked out of a market. And I go back to property and think, well, what happens when the investors start to unload their properties where there's no capital gains? What happens when people realise that rates aren't going lower? And I think a lot of property is speculation. And we saw these families that have bought in outer Melbourne suburbs on credit cards, and there's no facilities. There's no shopping centre, there's no doctor, and they're pretty much a prisoner in that suburb, and there's no roads to really get out of the place. And I think that is peak land speculation where they've bought it on credit cards. So anyway, this is what I'm doing. So take it or leave it. I don't care. I've been doing this 25 years. I've had, as I mentioned, I've had a terrible 18 months, probably the toughest of my career, but out of adversity comes opportunity. So we've been buying Maronan Metals. It should be noted that I'm a top 20 shareholder. They've got a deposit near Cannington, and I went on a Presscat Capital video. They're saying that with those silver grades close to surface, it could be another Cannington. I think that that's probably an overly bullish stance to have, but they're drilling now a deep copper gold target. This is a lead, silver, copper gold resource. I think it's undervalued, so I've been buying that, 26 cents. Eagle Mountain have a copper project in Arizona. They're looking to get this back into production, first class management. Now, what happened with this stock was that if you read their quarterly report, they're running low on cash. So it got absolutely poleaxed by people expecting a capital raising. They just came out and said that Charles Bass, who is the director of the company, is offering up to $3 million in an unsecured loan. My experiences with Charlie Bass go back to Eagle Mining, in the mid-90s, and he was also successful with Aquila. This is a real copper project in Arizona, one of the great mining jurisdictions of the world. Again, a stock to look at with money you don't need tomorrow. Proteomics, one of my favourite stocks. This is in trading halt. They're about to announce a distribution agreement with Sonic Healthcare in the US. This is for a blood test that predicts the onset of diabetic kidney disease 3 to 4 years before it happens. Bindi Irwin has been in the press with her struggle with endometriosis. Proteomics recently announced that they have a blood test, simple blood test, early stages, that has detected endometriosis with a 90% success rate. Endometriosis unfortunately affects 1 in 9 women and takes 7.5 years to diagnose. And coming up in the background, they're working on a test for esophageal cancer, which tends to follow acid reflux. So hopefully they come out with some good news over the next couple of days. But to me, that's another quality company. Growth ahead, if they can develop this endometriosis test, because it could be the gold standard and save invasive surgery and 1 in 9 women. So the market's huge. Narada, moving towards a test. It's a drug for cholesterol. It's an inhibitor. And interestingly, the stock has been sold off. I recently went on market and bought some more. I think that gets me back on the top 20. So what's happened with them is it's just boredom. Stock gets sold off. They've actually put a guy on as an advisor called Seth Gordon, and he was previously involved in the marketing of Lipitor, which is one of the largest selling drugs of all time, and that's a statin. So certainly one to watch. It is cheap at 9 cents. When you take away the cash, it's a stupid valuation. But this is what's happened to the biotech sector. It's been absolutely carted. Dimerix, they've just announced a capital raising, so the stock got trounced. They're in phase 3 for a FSGS kidney disease where there is no treatment, there's no drug to treat it. That kidney disease often leads to dialysis. Dialysis is an expensive, nasty bitch, which costs up to about 90,000 US. The other drug looking at that disease has just failed its phase 3 endpoint called sparsentan. Sorry if I got that name wrong. So we're not going to see a readout till first quarter next year, and that might have contributed to the selling, because no one can wait for their 2-minute noodles to finish that takes 5. So another one interesting in kidney disease where there hasn't been any breakthrough treatments for 20 years. I just think it's very rare too to have an Australian biotech in phase 3. So to me, that's rock bottom. Hasn't been kind to us share price wise, but who has? Chimeric, very exciting developments on extending the life for people with glioblastoma. That's the nastiest form of brain cancer. That drug is showing some encouraging signs in the clinic. They also have another drug, CDH17, which in engineered mice knocked out 7 different tumours. So that's got a while to get to the clinic. Now this stock's been sold off quite heavily, which sucks for us because it just sucks. And what I think's happening is they're probably going to need to raise money at some point. So punters pile out of it, expecting the cheap capital raising, and it becomes self-fulfilling. But I encourage people to watch the interviews with Jennifer Chow. I think this is one of the most exciting biotechs on the market, and it's getting even cheaper. Oryaman, another gold stock that's been harshly treated. First-class management that used to work with Bill Beeman at Northern Star. This one's been on the capital raising hurdy-gurdy as well. Every time they try to raise money, it gets sold off. That ounces in the ground, that's one of the cheapest gold stocks in the country. I'm backing management. It's going to take some time, but around 2.8 cents, I think it's being given away. Interestingly, they got an EIS grant to drill for lithium as well. I think lithium's probably getting a little bit ridiculous, and it's going to get to the point where you go to your friend's piss up at 3 a.m, the police have shut down the music, and you deliver a vegan pizza. So we're seeing that with lithium, we're seeing that with rare earths. Everyone's got a rare earth project now. What it does, it provides a decent sugar hit to your share price. But I just think that what I'm seeing now reminds me of the dot-com bubble, where in order to get a lift in your share price, you just go for whatever's hot. A lot of these companies will go into stealth mode and they'll wait to the next bandwagon. So something to be aware of. The lithium sector was struggling until that bid for Liontown, which pretty much wiped out the ASX shorts in it. So it's a market where it's hard enough to will something to go up, but when you're hoping the stock dies and you get a takeover bid, that kind of hurts. And again, you've got to reiterate that when you're short a stock, your losses are unlimited. It's a bit like putting a pineapple in a pokey at the Rudy Hill RSL. Saturn Metals, one of my favourite gold stocks. They've got a 1.47 million ounce resource in WA. It is heap leach, which means you treat the gold with acid. You don't build a traditional mill. The analyst at Shaw's has had to discount his valuation 50% because Australians don't get heap leach operations. Their valuation was 93 cents. I think they've cut it to 44. A major fund, Sprott, has been selling that stock, but Sprott has many arms, so we've been picking it up. And I've watched these companies grow, like the likes of Saracen. Capricorn is another one that went in with some low-grade projects, and these things just grow. So, yeah, it's going to take a few years, but with ounces in the ground, both Saturn and Orient are the cheapest gold stocks on the market. Adalta, they have a drug called AD214, which is looking at idiopathic pulmonary fibrosis and silicosis, which is caused by the engineered stone for the kitchen bench tops. They had 5.5 in the bank, and they're now looking to raise more money to accelerate the progress of that drug into the clinic. Obviously, they're looking at partnering deals. To me, it's just too cheap. But what happens to a lot of these stocks is when you announce a capital raising, you tend to go back to that price fairly quickly. And it's a brutal market at the moment. So investors, speculators realise that these companies need to raise money. It's the worst possible time as well. But through the adversity, as I said, comes opportunity. And my most successful stocks for clients over 25 years have come from low levels, not when you buy a stock at 20 cents, it sits at 21 and you're comfortable. So again, yep, we're getting beaten up, but it'll pay off. Radiopharm just announced orphan status for a screening, imaging for pancreatic cancer. When you go orphan, you get 7 years in the US, up to 10 in the EU on marketing. You do get incentives as well. So that they're looking at prostate cancer, pancreatic cancer. To me, that's got an excellent pipeline, and it's a medium to longer term stock, but they're certainly putting the runs on the board. So they're 10 we're certainly focusing on. And the other instrument where I strongly suggest you do your own research is the BBUS. So this tracks the S&P 500. So for every 1% the S&P 500 falls, this should put on between 2 and 2.5%. It is absolutely volatile. So with the US markets staying overvalued, it is trading at about $9.28. It did get up to about $13.55. So you can trade this around. And interestingly, Better Shares, they returned a distribution of $1.12. So this thing suddenly is on a 10 to 11% yield. And the reason why they returned that money was because they had trading profits with the futures. So they used futures to hedge against the S&P. I should make it known that the pricing is on a daily basis. They do have management fees, so the exact percentages aren't going to work out in relation to the longer term decline of the S&P 500. But I think there's going to come a point where you'd certainly use this as some insurance against the major indices. So I think that's, quite a prudent step. I know my clients, we have had some profitable times with it. We've had some hard times. I guess we're just waiting for markets to finally wake up. And I guess it's the same thing with property in Australia. So well worth doing your own research on that one, but we're certainly in there. And I think that's what you have to go through in life. Andy Dufresne goes through that chocolate syrup. I know I use this slide a lot, but I think it sums up that, you've got to go through times of adversity to end up on the beach. But as I've mentioned earlier, guys, it saddens me to watch that young couples forced into ridiculously high mortgages, about to hit the cliff, no real wage growth to next year. I don't think the $500 electricity bonus is going to do much at all. I don't know how they're going with these stage 3 tax cuts. I don't know what they're doing with it. Maybe they're going to scrap them. I don't know if anyone's got the update on that. So unfortunately, that's where we're heading. And defend, sandbag your family's finances. I think that as a society, we're going to be more prudent. You've got to look at where we spend money. I've completely cut out takeaway coffees along with alcohol because they're pointless. You can get these pods for 37, 38 cents. I don't see the upside. Once every couple of months, I crave KFC. It must be some ingredient they put in there, but you can get away with that relatively cheaply. I've cut back. I don't go to wine tasting events now because I'm not drinking till the end of the year. Again, dinners when you go out are cheap, but in the end, I just can't see how you can beat a perfectly cooked steak with your partner at home now. And I think that's where Australians are going to head. So that's it.
Thank you, Tony. And just to reiterate, not financial advice, just a general discussion around some of these things. But it is worth just reflecting on the uncertainties in the markets globally, right? So the volatility is the thing that really gets me. If you look at the last few months, prices have been up, they've been down, all over the place. And I think it's because not many people are able to read what's going on, and not many people are taking clear views. So there's a lot of volatility trading going on at the moment.
I think I've got a saying that markets are essentially a collective of people with no friggin' idea what they're doing. Well, that's it. And I look at it now where prices, are you going to buy that cheap house in North Curl, or is it going to drop further? Is the world going to end? Are we all stuffed? I see it that no matter what we go through, small companies always become big ones. BHP's going to snap, they've bought Oz Minerals. There's going to be takeovers. Pharmaceutical companies are still going to take over other pharmaceutical companies. Yes, investors are scared, prices are low. And there's a saying, the stock market is the only market where when prices are low, everyone leaves the store. It's just amazing that it goes like that. So I'm just going to stick through it. It's been tough for us, and I guess you're sitting there at the wedding and the person next to you gets the perfectly cooked steak and you're not making money, and then suddenly they're trying to get you to join the crypto cult as well, and you can go on the Sportsbet app and bet with mates, and sometimes you've got to miss out. But now I just think that you can cut all your costs down, and I don't think it's going to save a lot of families. And I think that we're in this period of denial, head in the sand. All the economists can come out and say everything's all right, but higher for longer, sticky inflation, retail spending is starting to reflect where we're heading. So I just think it's just an ugly time, and I can see where we're going, but many can't because they adopt this attitude that she'll be right.
Well, you mentioned cash flow and households, and one of the things I've seen in my surveys is that households have no idea how to look at money in and money out. Only half of them have any cash flow data. Some are using apps, but a lot of people are still just saying, "Oh, she'll be right. It'll work out." And the longer this goes on, the higher inflation continues to drive the cost of living up, the worse it's going to get. And I just think that many people are still, frankly, asleep at the wheel.
Yeah, that's the attitude. We had record low interest rates. Well, they couldn't have gone any lower. And yeah, that's just complacency now that you can go out and buy now, pay later. There are times you can go for lunch and it doesn't matter who paid the bill. But I think we're certainly going to get the hangover coming towards us now. And I just think a lot of the population have been duped into thinking, well, you need to buy this, you need to keep up with others. Who cares? I think one of the lessons I've learned, Martin, is, I sit next to my 15-year-old son driving, and I just say to him, there's no point talking to you, is there? Because they're on this TikTok, and what essentially is happening is we're going to have a generation of investors that can't hold on to anything, that want that instant gratification. There's very few coming through the ranks that are going to be Buffett-like, that can build wealth slowly. They all want it now. And again, thankfully, by the time he's looking to buy a house, or that the prices will be realistic. And I go back to that realism, Martin. I'd like to look after my kids. If my stocks were doing a bit better, I would have happily looked at getting a place for them. And I walked into a house, $600,000 I could probably buy it for. But then I thought of the interest rate, and I thought, shit, I don't want to be paying 42 grand a year interest. I mean, this is absolutely ridiculous. And I know some of the other interest rate brochures now would suggest 8%. So I don't know how you can pay that amount of interest. I think Perth, obviously, it's relatively affordable, albeit still expensive. But I don't know how families cope in the likes of Sydney and Melbourne, because it's just unrealistic where things have headed. A lot of it is the books are cooked. I mean, they're borrowing money from the bank of mum and dad, which, as you've reiterated, is the 9th biggest institution in the country. And that's going to be dominoes once the guarantors for those properties start to tumble as well. So I just don't get it. And I know we've been warning for a long time, but sometimes these things take a little bit longer to unravel.
I also highlight that property investors, I see it in my data, quite a few of them were hoping that the price rise will continue. But of course, what's happened is now that prices are not really going that high, but the costs of the mortgage have gone through the roof. And what that means is that more investors are now, well, frankly, just looking to sell and get out. So that's one of the reasons why the listings are quite interesting. There are new properties coming on, but quite a few of them are old investment properties that need a lot of work and frankly aren't really that valuable at the moment. So I think that's another factor in all of this. And that's why in my surveys, some of the worst pressures are actually among more affluent households who have multiple investment properties, and they're all going wrong at the same time.
Yeah, and they all have Q5s and private school. I think that's another area where kids will start to get yanked out of that. I can't see how some families pay 100 grand a year to send 3 kids to a private school. The kids are either talented, keen, or they're not. So you look at the other debt outside of mortgages, and it's frightening. And there's one other area would be the unpaid tax on the hell run from 2020 to 2021. And I'm sure a lot out there haven't set aside money for their capital gains. So they've got that to look at as well. You've got HEX debt. I think that's going to go up to about 7%. So it's just a mountain of debt, and families are going to realise that what's this consumerism? What does it mean? It means absolutely nothing. We're just in a disposable society, and that's why I put up those units and houses back in the 70s, where we had to wait all year for a present. I remember I had my Parachute, Game and Watch and Popeye, and my parents bought me a Toy World BMX bike. I mean, to me, that was life, where we'd go surfing. We wouldn't sit there binging and watching TikTok all day. And I think that's where life will slowly head. But unfortunately, a lot of hardworking middle to upper class Australians are going to get wiped out with interest rates where they are, trying to get inflation lower, again, by handing out a lot of money. So those that are getting all the help are going to go out and spend it, and that's inflationary as well. So I just can't see how, it's going to be like trying to land an A380 without landing gear or a manual, Martin. And unfortunately, we're going to see it in our lifetime. And who would have thought we would have seen a global pandemic, which I think WHO have just announced that it's not a major issue anymore, where the effects of long COVID, you look at Britain, what's happening in the UK where you are, long COVID is rife. And we're going to see that here, and now we're going to have lawsuits and bada bing, bada boom, and lawyers are going to make all the money again. So, it's certainly interesting time to be alive, and future economic students and aliens are going to have a laugh at our expense.
Yeah, maybe the aliens more than the economic students, I have to say. Some of those students do seem to be still on the standard monetary philosophy. The thing I'm worrying about, Tony, is that interest rates can rise and it can crush people, but it may not actually crush inflation. So we could still be in the situation where inflation stays high, and that leads then to a depressionary turn or a deflationary turn. And if deflation starts to set in, then, the value of many assets are going to go significantly down. And I'm not sure that central banks have the capacity to rescue that. And I still get from a lot of my surveys the idea that the government will save us. Magically they'll be able to pull a rabbit out of the hat. I think they might just be out of rabbits.
Oh, well, where was my bailout package when the biotech stocks got hammered? So, we're there to make a difference. Property speculators are there to make money. No one is going to get bailed out. And I'll keep getting back to those two magic words, price discovery, where it's only going to take a few sales in a suburb and it corrects 20%. And sometimes in my life, I've gone on and bought concert tickets and I can't attend the concert, or I've stupidly not asked my partner if she likes something like Def Leppard. And then suddenly I've got to sell those concert tickets. So I know I've got to get out. So I sell them below face value and someone buys them. So again, it gets back, Martin, that if you're going to panic first. And I know that there'll be lots of calculations on, they need to get their break even. They need to get what they paid, the stamp duty, the removalist cost. Sometimes it's best to take the hit early on rather than have to go bankrupt in the future. So, that's my fear. And obviously we live in a pretty decent, well, probably the best country on earth, but we don't want to see the country turning into France, where they'll just happily destroy it. And hopefully we're not going to see the crime waves that you get in the US. And unfortunately, financial stress leads to other stresses and desperation. So no easy way out of it. And if you've got a solution, Martin, I'd be happy to hear it. But you cannot get out the textbook to treat a non-textbook situation. The non-textbook was interest rates at 0.1, cheap money, get your black T-shirt and logo, conquer the world. buy your house, get the books cooked, go to mum and dad, get into your house, pay $2.2 million to live in French's Forest, if that makes you happy. And then suddenly you've got an issue. So that's what we've come through, largely caused by COVID. And you just have to look back at the election where the Morrison miracle, house prices then were falling, but that turned it around. Then we got COVID. But probably now on an historical basis, the long-term average mortgage rate is about 9%. 9%. So, ouch.
Yeah, and people were arguing quite recently that the cost of money was different now, right? Interest rates were going to stay really low forever. I remember you said it earlier on. And even central banks believed it. And I think they also believed that they had the power to solve all of the problems, and they were keeping all the balls in the air and, printing more money and all of those things. And all of those strategies are looking like an aberration now, because what they've done is to create a huge debt load. They've created a massive amount of difficulty amongst many households and businesses around the world. The total debt pile has never been bigger. And now rates are going up. And the thing that I think that is really fascinating about the budget today is how much the cost of government debt now is relative to where it was just a year plus ago. That's the factor that people haven't woken up to. And that's why this higher level of interest rates that we've got is going to have a huge negative impact. It's on houses, it's on businesses, and it's on governments. And I'm not sure that central banks have any tricks up their sleeve, because they are now quite close to the end of the runway, I think, in terms of what they've got. So that's why reducing debt rather than increasing debt, and knowing where you are and being cautious, is probably good strategy. But unfortunately, that's a very unpopular message, and there are still many out there who are spruiking a different strategy and saying house prices in Australia, they're going to go up again. Great time to buy. Well, I'm not sure that's true. So we are in a very interesting part of the cycle. I blame central banks, I blame governments, I also blame greed as well. And all of those factors seem to me to be driving us to an inevitable denouement, which is going to be, frankly, very uncomfortable.
Yeah, I think we're probably going to be more island than Japan. So, and that reminds me, I was when I was splashing money around, I followed Pearl Jam around Europe, and I was sitting there in a hotel in Dublin, and on the front page of the paper was families in negative equity. So that was making the front pages in 2010. So this negative equity mortgage prisoners, it does take time to filter through. So we know what happened to Irish house prices. I'm thinking that, if we can have something more along those lines, we haven't even started on commercial real estate yet on a global basis. So it's certainly looking very ugly. We look at Albanese came in, a wave of popularity, and he can do no wrong. Who the hell advised him to go to Kyle Sandilands' wedding, for Christ's sake? I mean, suddenly he's going to cop it for that, and that was just a poor decision. So again, he's got to be careful, but he hasn't got much opposition at all. So it's just absolutely strange times, Martin.
Absolutely. Which takes me to an interesting question, because you mentioned the gold price, right? It's above 2,000 US. And it's interesting that quite a lot of professional investors, particularly in the US, have started to increase their holdings of gold. A lot of retail investors are actually not going for gold, but going for Bitcoin, according to some of the research I've seen. So there's an interesting diversion or division between professional investors and retail investors as to how to try and buttress what's going on at the moment. What's your perspective as gold versus Bitcoin?
Well, actually, I'm a bit of a smartass, let's be honest. Dad, I was recently at a dinner party, and I said, well, there's 6,000 religions, there's 21,000 shitcoins, and every one of them is right. So I've got to look at all the scams. It's just amazing when it comes to money. There's scams, there's rug pulls. I know a lot of people that will dollar cost average Bitcoin, and as long as it keeps going, they're probably going to make a lot of money. And that's if they're happy with the risks, if they're happy with where they're stored. I knew someone that took their Bitcoin off an exchange, and a junkie broke into their house. Well, sorry, I shouldn't assume they're a junkie, and they lost their Bitcoin. So I look at, there's a lot of more talk on Twitter about stuff going to the moon. If you can make money out of Bitcoin, great, go for it. If you get lucky on one of these lesser lights, good luck to you. But the way I see it is, you might as well have the sports bet app open because you're gambling. And they've bagged the crap out of gold for years. And what I've noticed is, I think it got to $2,080. The Australian dollar gold price over $3,000 an ounce. So a lot of gold producers will start to hedge where they'll get that price locked in. But apart from the majors, there's been no hype in the junior gold stocks at all. And that will start with consolidation, M&A. And the last ginormous gold bubble we had on gold stocks was 1978 to 1980. So it's been a long time, and it's hard to forecast a bubble when you're not actually in it. But if coal and iron ore can have 3 cracks at it, I don't see why we just can't get back to a traditional gold and silver bubble and let the best gamblers win. So, but I know that gold over time has maintained purchasing power, and it will be here. It'll be here to stay. There's talk about some more reputable crypto industry types going under, and there's lots of risk. So I actually saw some posts on Twitter today about McAfee. He was good in the virus software, made his fortune, then said that he'd eat his genitalia if Bitcoin didn't get to $1 million. So, I mean, people are certainly going to believe that, but I'm the type that I'm happy to be boring. I'm happy to watch others make money. I'm happy to have people knock at my door, try and get me to join the cult. I've got no interest in that. Whatever makes you money, I don't need to go out and fight it. Do whatever's right for you. I know that buying real small companies that become bigger ones, you've got to have a long time frame. And I'm not far off turning 52. And anyone younger than that, don't worry about the long term, because it's better to make consistent returns over the long term than blow yourself up on some speculative assets. And I mean, what I'm trying to do is, when we make profits in speculative stocks, I do have some small industrial companies that I am looking at that are starting to pay dividends. I cannot mention them publicly anywhere because they trade via appointment. So, and the way I see it is that, where is the income going to come from? You just can't go out and drive Uber anymore and make the good money that the early adopters did. All the jobs that Australians don't want to do are taken. OnlyFans has diluted itself. Apart from those that got on there early, now everyone wants to do OnlyFans. So the sources of second and third income are drying up. And I think the population on the whole are gullible and stupid, and they'll start to take increased risks. So I still think there's going to be a wave of speculative bubbles that will dominate. And I know that when I go back to .com, oh God, there's been bubbles in retractable syringes, childcare centres, eggs, potassium, uranium, vanadium, scandium, modium. God knows where the next bubble's going to come from, Martin. Maybe it's going to be, they're saying the art market's pretty good, so invest a portion in artwork, classic cars. I don't know if you've got anyone's got an old Holden Commodore in the garage they haven't driven. But yeah, I just think we're going to see an increase in scams, fraud. But whatever way you need to survive and make money, yeah, just tread your own path, as Scott Pape says.
Yeah, and I can remember olives, and I can remember ostriches a few years ago. Right? So lots of different options, many of whom are there to, frankly, provide funds for the people playing rather than actually investors. Many people lost their shirts, particularly in olives. Last question, Tony, before we close. This migration question. Right? 400,000 over the next year or so, 700,000 over the next 2 years is what Treasury is talking about. Does that change your perspective at all in terms of Australia and, property? Or basically is that just a furphy relating to bringing people in, maybe younger people, maybe people who are willing to work for less, rather than actually fundamentally changing the property market? What do you think?
I just see it as a bit of a furphy to keep things going. And I remember just before the GFC that the belief was that super fund inflows would keep the market pumping. And the ASX 200 essentially halved, and margin lending rates fell off a cliff. So that was the fuel. And there was a time where margin lending organisations were offering stockbrokers trips to Hawaii to sell these products, and that fueled the market. So once you take away the fuel, which is cheap money, etc., you're going to have the market start to capitulate. And I don't think those levels of immigration are going to solve anything. It's going to be good for those that in student accommodation. I still think that you look at the vacancy rates, especially in Perth, they're diabolical. And where are all the jobs going to come from? Where are these people going to go? Are they going to suggest they go to country areas and try and build up economies over there? How they're going to come in with $400,000 deposits to buy a 2-bedroom knockdown in Campsie, I just can't see that happening, to be honest. And you can come up with every excuse as to why this is a new paradigm, but it ain't going to happen. And what I'm kind of hoping for is that we see a price earnings ratio expansion in Australia, where the stock market becomes a bubble here. You look at the Nikkei back in 89, 90, it got to 52 times earnings. I think Japan Airlines was on 900 times. So can our market, can Australia become somewhat of a safe haven? Yes, property has to fall, it has to get back to more affordable levels, but can we see our stock market go nuts? Can we see PE ratios go from 15 to 25, 30 times? I think there's got to be a chance of that. And again, it's a new paradigm because the stock market should be priced at 30 times and not 15. So that's where I'm hoping we see the stupidity, Martin. And I don't know. I just can't see how you can justify chronically unaffordable asset classes, basic shelter. Everyone's made their money. If you want to, you can take your lotto win and run. But no, I just don't think any immigration, any government handouts or schemes are going to make a difference, because speculative bubbles collapse. They always do. They always burst. And the day the NASDAQ died, it was crickets, absolute crickets. And you do have that speculative element, as I said, in land and property. So the answer to that's pretty much no.
Yeah, well, that's my view as well. I think that the property spookers are overdoing it. And I think, like you, I still think there has to be a further adjustment to asset values, including property. It'll happen. It'll happen relatively slowly. It'll be very uncomfortable. It'll be very painful. But I can't see any alternative, unfortunately. So there we are. Tony, I really appreciate your time today. It's been great to catch up with you and get your latest thoughts. Thank you very much. We will do it again down the track relatively soon. And hopefully I'll be able to get my full studio up and running in a few weeks. The crate is somewhere between Australia and the UK at the moment, so I'm expecting it to arrive in due course. But really appreciate your thoughts today, and look forward to our next conversation in a few weeks.
Yeah, hopefully eventually, Martin. On one of these chats, there'll be more good news than the Bible, but unfortunately I can't see that happening. So I don't know, I might have to play guitar or something, or yeah, but I stick to my guns, and hopefully I can get over to and see you next year. I look forward to that.
Yeah, well, you'd be very welcome. Bath is a great place. Got country walks just around the corner, and believe it or not, the sun is just shining now, so it can actually be bright in the UK as well. Well, thanks very much, Tony. Really appreciate that. I'm just going to close the show now, and just tell everybody that if you like the show, please remember to do that, and share the link. Next week, Leith Van Onselen will be on, and we're going to be talking about his latest calls on property. He's gone really bullish, so I want to explore that with him, and I'm sure that'll be fun. So mark your diaries for that. And I've got some other people coming the following weeks. We're going to talk property, we're going to talk markets and other things too. So thank you very much for spending some time with us today, and I look forward to seeing you on the next live show, and follow the other shows meantime. So this is Martin North from Digital Finance Links signing off, and once again thanks to Tony.